All right, knocking a minute off of the clock here because I realized that I just started streaming and didn't start the timer. Here we go. 4 minutes until go time for those of you who are watching already and waiting patiently. Welcome back, and we are 3 minutes and 50 seconds away from getting into it for the upcoming week. Three and a half minutes until go time, and if we get up to 30 viewers as indicated down here, we will launch into the HT giveaway. We have not done a very good job advertising our streams lately, so they've all been kind of last second. But if we get up to 30 viewers live at any point during the stream tonight, we will activate the HT giveaway. Electro checking into the Twitch chat. Happy Sunday. How we doing? We are at 8 viewers right now. I'll consistently update you guys. Maybe I could just keep this on the screen so we see the chat as we go. But I think whenever I click on the browser, this window goes to the back. But 8 viewers right here. If we get to 30, we are doing another HT giveaway. And for those of you that have previously won HT giveaways, those have been shipped, so you should see those. I don't know how soon. I got to be honest. I did the cheapest shipping option, so do not expect them overnight, but they are finally at long last on the way as we are 45 seconds away from getting things started tonight. All right, 15 seconds to go, and you know what? Let's just get into it. Closing this out. Welcome back to another weekly edition of our option selling stock market discussions, whatever we want to call it. Yeah, welcome back. And obviously, the market has been tough lately, as evidenced by this red line here, which is the S&P 500, kind of just taking a little bit of a consistent dive over the past 2.5 months, which has been a tough environment to trade in. And it has been a tough year for us so far, as we are, I think, down 20-ish% on the year. But in order to help cope a little bit and kind of put things into perspective, we always like to talk about how we have a long-term approach to the market. And this is a good way to help visualize that, right? Ever since we started publicly tracking our trades, which is back in June of, there we go. Okay, good comment from George in the YouTube chat. If we can enlarge some of the things on the screen. Absolutely. And if anyone, let me click on the browser first and try to get this to zoom in. Why won't she zoom in? Control plus. Why aren't you working? There we go. Oh, I guess it was lagging. Okay, so for those of you who are watching on the phone or a smaller screen, hopefully this is big enough. Oh, nice. Pony, what's going on? All right, so here is what we got, right? And we always like to talk so much about how we trust in our strategy. We like to trust in the process, and it's a long-term approach that we have to the market. And this is a really good way to help visualize this. So this is, I guess, what we can call since inception, quote unquote. And by inception, we just mean when we started publicly tracking our trades. Now, for those of you who have been following us a long, long time, you'll know that even before June of 2020, we were making a really good amount of profit. But, it's one thing to just say, oh, we made a lot of profit. And it's another thing, I think, to say, here are the actual trades. We have proof with evidence. That's when this started. So that's the point of reference we're going to use. That hurts us a little bit, but I think it's the most fair way to look at what we have. And since that date that we started publicly tracking our trades on here, June of 2020, we are significantly outperforming the S&P 500, right? And this includes some very, very big drop-offs, right? Those of you who were with us in the unfortunate month of October 2020 will remember when we were playing Hyliion, which was a SPAC that got all the way up to like 50 at one point, and we loved the volatility, we loved the premium, and we got crushed by it. We lost, I think, $50,000 in a month on Hyliion, but it's one of those things where we have absolutely adjusted and improved our strategy to, avoid similar setups, and which is why anytime someone suggests a stock where there's just been a huge run up on the front end, they're like, should we trade this stock? Our answer is absolutely no, due to lessons learned from this drop. And it's one of those things where a lot of the time when things are tough in the market, a lot of people will tell you that the most effective lessons in the market are the most expensive ones. And that is absolutely the case here. We adjusted the strategy a bit. We tweaked a few things, and that led us to a great run from November of 2020, really up until the end of last year, where we went from a negative return to almost a 150% return at the peak. And, over the course of 18 months, that is a phenomenal, phenomenal run. So we've given a decent bit of it back this year. That's, that is what has happened. We cannot avoid the truth there. But again, that's one of the realities of trading. But even with all of this taken into account, right, we are sitting, and I have the actual exact numbers down over here, right? We have an 86% return as compared to a 40% return from the S&P 500. And if I could scroll back up to this chart, that's a pretty significant gap. And one of those things where we do use a little bit of leverage, we got burned pretty badly with a lot of what we were holding. And I think what you see right here in this chart, quite frankly, is what could be termed as a little bit of a worst case scenario. We had leverage positions in Roblox. We had leverage positions in Affirm. And those things dropped over 50% on us. And another, one of those things where this big drop has presented us with a really nice lesson as far as adjusting our strategy. We thought selling out of the money puts on something with a little bit of leverage would work out pretty well. However, we didn't account for the fact that there would potentially be a 50 or 60% drop in these stocks. But you know what? Big drop, lesson learned. But at the end of the day, we're still winning the race. And that is the single goal that we have every single week in the market, just to outperform. And we haven't quite done that this year. Let's flip over to the more relevant discussion, perhaps, which is what's been going on this year, as we're down 24.34% this year. But all things considered, when you look at the stocks that we've been trading, Palantir down 54, DraftKings 55%, Affirm down 61, Roblox down 58, Fubo down 62. Those are very, very, very significant drops in stocks. And the fact that our entire portfolio can really be made up of pretty much just those, and we're still alive to tell the tale, I think is a great testament to, one of the most important focuses of our strategy, which is just conserving capital, living to trade again tomorrow. And there's a little bit of volatility, as George mentioned in the YouTube chat, because we did target some growth stocks, and I think stock selection is definitely a little bit bigger of a part that we're going to focus on. And I think I have a really interesting tidbit about beta and scanning for beta tonight that we're going to talk about that we haven't really introduced in the Discord. And I think it's going to be a really, really interesting conversation to have as we get a little bit more into the conversation of, the strategy is sound, but how can we do better at picking stocks and be prepared for when the market is turning down? And I think if you'll look relatively right, when we kind of got caught with our pants down, so to speak, in January when we dropped 38K down to here, From that time in January to now, we've shed a couple percent. In that same time frame, the S&P 500 has shed about 7%. So going from January onwards, we have outperformed the market. But again, there was a significant decrease in January. We dug ourselves a pretty big hole, but it's something I'm confident that we'll be able to dig our way out of, right? Looking at the numbers, 43K down for the year seems like a pretty big number. Don't get me wrong, that's not insignificant money. But again, we're not going to try to hide and say, oh, we're only going to show you our winning trades, because that would not give you a realistic picture of what trading is like. This is what trading looks like. But when you zoom out and don't take such a micro look at what's happening over a 3-month period, this is the general trend that you'll see from our strategy. So this is what we're focused on. This sucks in the meantime, don't get me wrong, but as long as we don't get over leveraged, as long as we don't get margin called, as long as we can afford to hang into some of these positions, we are going to make it out okay. And let's talk about how we're going to do that first with a recap of what has happened last week, as I take a quick sip of water because we've got a lot to talk about here. All right, and last week, I think I would say was particularly frustrating because at one point, the market was down 2.66%. Let's not ignore that fact. That's a pretty significant drop in the market. However, I think at about Wednesday, we were making, or at least on track to make, a decent amount of money in the market. And so we were looking pretty good. Now, what did we do from there? And there were a couple of things that we did during the week that I think really helped us out. Can we zoom in on the weekly? We can absolutely zoom in on the weekly. Let's make it a little bit bigger here. Why aren't you working? There we go. So there are a few things we could do, or I guess a few things we did to help us save a little bit of money, right? We lost 6%, but it could have been worse. Why could it have been worse? Spoiler alert, you look at a firm right here, it was down 15% just on Friday. That is insane. Roblox additionally was down 5.38% on Friday. And we know that Fridays are big days for us because that's the day that we roll our positions, right? That's the day that we close out what we had for the week, get into positions for the upcoming week. And, performance of stocks on Fridays is important for us. And we had just about as bad of a Friday as you could have about 2 days ago. So that's all important context to keep in mind as we go through this. Let's talk about some of the good first, right? Let's talk about some of the good. Actually, scratch that. Let's talk about the bad. We're going to learn more from the bad, and we could circle around to the good, and then we'll get some good feeling going as we talk about the upcoming week in the market. But the bad right off the bat was DraftKings. This is pretty much the extent of our loss, right? If you take DraftKings off, this accounted for a $7,400 loss. If you take DraftKings away, our performance on the week is negligible, and we're really outperforming the S&P 500. However, you can't just take a position away. That's cheating. And if we look at the DraftKings chart and we bring it up right here, what we saw was a very steep decrease in the price of the stock, right? Things were good just on March 1st, 12 days ago. And I remember everyone saying, oh my gosh, DraftKings has run up to $25 a share. We sold 21 strike calls. What do? We sold calls way too low. And then by Friday of that week, March 4th, it was back down below 21 a share. And this is why we stay patient. This is why we wait. So similarly, when DraftKings runs up to 25 and that's above our 21 strike, we don't panic. We wait for it to come back. Likewise, when DraftKings drops severely from 21 down to 1606 at the low point, do we panic? No, we just wait for it to come back. The market goes up, the market goes down. Even the stocks that have, really had these huge downtrends like DraftKings, there's a little bit of a wavy, almost sine wave-like pattern that gives us little pockets of opportunity. The initial drop to 16 hurt really bad, but again, within 2 weeks or so, it was already back above 20 and gave us some decent pockets of opportunity. So let's take a look at this overall trade, because I think this is probably the most important context to have, is the fact that, look, we started playing DraftKings end of November, and I'm sure you guys have heard me give this spiel several times before, so I'm not going to spend too much time talking about the process that we've been through so far, but we started playing it at 36. It's at 16 now. That's a 55% decrease in the stock in just about 15 weeks since we started playing it. That is a huge reduction in a very short amount of time. So as would any other bullish position, we're losing some money on it right now. We're losing a decent bit of cash on DraftKings. And the shares themselves have lost, roughly 20K. The puts that we sold initially lost 4K. But here is what we want to focus on, and it is our break-even price, right? We started at 36. And from the end of November until last Friday, which was, I guess we uncovered these on Wednesday. We uncovered them on Thursday, I think, when it was pretty clear that DraftKings wasn't coming back up to 19.5. But we got it all the way down last Thursday to 21.35. So in just roughly 2.5 months, December, January, February, let me think. December is 1 month, January is 1 month, February is 1 month. So 3.5 months, we have dropped our break-even price by about $15 a share. And so all that to say is that, look, DraftKings is about $5 below our break-even price. So if we're patient, we wait another 1, 2, 3 months. Yes, this number sucks right now. However, what they can't take away from us is this call premium that we're collecting on a week-to-week basis, right? Ever since we were assigned these shares, we have collected $9,340 of call premium just since the end of January. And again, this is all locked in. We are keeping this $9,000. This is all to help mitigate the share losses. But again, the idea is that DraftKings isn't going to go down forever, but every single week we can collect more and more of this call premium to help mitigate the losses that we're looking at. So now the question is, since we don't have them covered and we left the shares uncovered, why did we do that? The answer is, if you look at RSI, it's down in the blue, right? 29.63. Typically, when DraftKings gets down into the blue, we see some short-term rebounds. When DraftKings gets into the blue, right? Look vertical, look right up in the graph right here, we see a little bit of a rebound. It's in the blue, we see a little bit of a rebound. So the idea right here when we sell covered calls is we want to wait for a green day, right? I mean, if it were just a normal flat week for DraftKings, one, we would have been just fine, but two, I would have had these shares covered by now. But look, over the last 5 days, this thing's gone from 21 down to 16.25. And at the end of the day on Friday, RSI was very, very, very low. I'm ignoring this because this was after hours. This isn't really a reliable reading of RSI. But I think it's begging for at least some sort of short-term bounce, maybe back up to 16.5, back up to 17, just anything in that area. Because right now, if you look at it, right, for the upcoming week, this next Friday, March 18th, yeah, we could, knock off 25, 30 cents, which is probably around what I would want to target. But I wouldn't really want to do that by selling 18 strike calls. I'd love to get that amount of premium in the 19-ish range. So if we see a bounce from DraftKings of any sort for the upcoming week, we'll probably be able to get these premiums, maybe 40, 50 cents up at 18. And then that's a better idea as far as covering those shares. I don't want to go too low, cover at 16 or 17, because if it does have another sharp rebound, and we know from the past 20 days that DraftKings is very capable of having sharp rebounds off these big drops, it's testing the support from the first time. I at least expect an initial bounce off of these levels. Would be surprised if we didn't get some sort of life in it on Monday. But hanging tight, hoping for a green Monday. If we look at futures, they're up 0.47%. So that is why I've left these uncovered. The idea is we want to get a little bit more. But again, the idea is that we still want to stick with this process, right? We don't want to just leave them uncovered for an entire week. We want to chip away a little bit every single week, because obviously we're still $5 away right now, and we're not going to be able to make up $5 in a week, but even 25, 30 cents a week is some serious progress, right? If we sell 35 cents of premium for the next 3 weeks or the next 4 weeks, all of a sudden, come April, our break-even price is going to be 20 a share. And that's irrespective of the stock price, right? By then, it could have easily bounced back up to 20, and we could be looking at a break-even on a trade where the stock has dropped 55% on us. So that's what we do. We sit back. Typically, we want to have these shares covered. We always like to have the shares covered, but when we've seen this much consistent red, at some point, something's got to give. I'm hoping that there's a little bit of a bounce. And if there isn't a bounce on Monday, again, we're just going to take what is available to us. We'll cover the shares by the end of the day tomorrow. And just keep moving as we move the break-even price down. So that one went poorly for us. The other two that went poorly were Affirm and Roblox, which is, I'm starting to sound like a broken record with those two. Between Affirm and Roblox, right, we lost about $5,000. What did we do? Roblox, we've rolled to 44 strike puts. That's all right. We're assigned the 50 strike puts. We got rid of those shares immediately. And I think the biggest thing that we did, though, was with Affirm, because it dropped all the way back down to 30. If we pull up the Affirm chart, let's talk a little bit about the performance of this stock over the last 20 days, right? It's gone from 54 to 30 after a just disgustingly bad drop from 37 to 30.4 on Friday. That was really, really tough because we were in position to make max profit on these, which if, we would have made about $1,500 as opposed to losing 46. That's a $6,000 swing. But again, that's just what happens in the market sometimes. So let's talk about the life of this trade. And let's talk a little bit about what we've done to help lower this break-even price that we'd like to talk about so much. So our initial trade was the 55 strike puts. They were sold very far out of the money. And I was pretty happy with the way that stacked up because Affirm was trading at $81 a share. If we look at the bigger picture and kind of what we were looking at when we were contemplating that trade is, look, Affirm was up at 176. The day that we looked at it, it was right around 81 a share after this big red candle. This puts you above where it was previously trading. And the idea that we had was that even if it did start to pull back and the market was going to pull back, it'd run into a little bit of the support and resistance from where it traded after the IPO. However, that really didn't happen as we saw some serious value get sucked out of these so-called growth stocks in the market over the past few months. So again, sucks that it happened. I think objectively it's terribly unlucky, but bad luck is part of the game. So what are we doing to help manage that bad luck and potentially turn this one into a winner down the road? We've got a pretty sizable loss on it, but again, this is not something we're going to hide because we love to parade out the winners that we've gotten. We can make the point that, ever since the end of January, all these new trades that we've entered have pretty much all been winners. So the new trades have been going very, very well as we've taken advantage of the volatility in the market, but it's important to get some of these ones that are lagging behind and try to say, how could we take this loss? One, prevent it from getting a lot bigger, and two, start to work this number back towards break even. So what we did off the bat was we kind of flipped some strikes around a little bit. Earnings happened. So we rolled up for a little bit more premium on some of these things, right? We originally had these March 18th 55 strike puts. We said, you know what? We can actually close these for a slight gain. And if I had a time machine, I would have just wanted nothing to do with the firm ever again. It's almost funny to look back at this one and know that we had a little bit of a gain at one point, but that's neither here nor there. But with the 57 strike puts, the idea was that we wanted to roll a little bit shorter term right before earnings because we know the shorter term expiries are a little bit more manageable. But after earnings, it fell off this cliff, this enormous red candle from 78 all the way down to pretty much 53, and we had to close those for a loss. So we were looking at a roughly $6,400 loss there. So what we said was, you know what? There's a $6,400 loss. What can we do about that? Let's sell enough premium to make that back. So if these theoretically expired worthless, we would have made $8,800, right? So the idea was to roll it to a strike where if a firm finished above 50, we would make $2,300 on the trade despite a pretty significant drop on the stock. We said, okay, I think that's a pretty good place to be at. But again, a firm continued to drop. So what did we do? And I think one of the best things that we did was we closed out of these and then we rolled them lower. Why did we roll them lower? Because, one, you might say, okay, well, this takes away a lot of the upside that you potentially had since there was $13.94 of premium. But two, we want to reduce further downside. As we talked about at the top of the stream when we were looking at our performance overall since inception, we really want to just have enough money to survive and trade again tomorrow because we know over a long enough period of time what we're doing works. It pulls nice returns. We're going to have some big bumps in the roads at some point, just like this, but the idea is to try to navigate this, manage the position on a week-to-week basis, and that's what we did. So we rolled the original position that we thought was going to save us as, a firm hopefully bounced back up to 50, which, it had a little bit of a bounce here to low 40s, so we were looking at a position where, hey, it might be manageable come March 18th, but another kick in the gut is when it had these huge red candles back down to 30, and it's now pretty much at an all-time low. So we have to figure out how we want to manage that. And the way to do that, we decided was, hey, let's roll closer. This is a less severe version. Remember the initial roll was from March 18th to February 11th, but we said, you know what? Let's roll closer. Let's start this trade over almost as if we were starting it fresh. And we did so with the 36 strike put expiring March 11th. But again, a firm kept sliding. But the good news about what we did here was the reason we closed this is because there was pretty much zero extrinsic value. For those of you that follow us, you'll know that extrinsic value, that's what we derive our option profit from. That's the little bit of advantage, the little bit of cushion that we get when we sell options. And when that extrinsic value is gone, basically what you're left with is a glorified position in shares with capped upside. So that's a little bit too risky with how big the position was. So we said, we've got a 18K loss. Let's just start over with some 36 strike puts. And those 36 strike puts did not go well last week, right? We were looking at potential max profit, which would have expired worthless and got the overall position back down to a 16K-ish loss. But what happened? Affirmed had this terrible, terrible Friday that we now have to manage. So what are we going to do here? Similar to the DraftKings discussion, this is insane red action right here. There is almost zero. I see pretty much zero relief on this chart. This is one of the craziest one-day charts that I've seen in a long time, off no news at all in the market. But again, we go back to this idea of RSI. RSI is very, very blue right now, so I think that we're going to get a bounce. So to combat the bounce, we stayed right at this 36 strike. Normally, you'd want to try to roll down and out for a credit or something like that, but hey, I think this thing is primed to bounce at least a little bit. I don't think there's anything stopping it from getting back to this 36 level come next Friday, so I at least wanted to leave myself a little bit of upside. And in doing that, we got a little bit of a credit, right? We closed out the original 36 strike puts for $4.39. We sold the new ones for $5.10. That's a roughly 71, I think maybe exactly 71 cent debit. And in doing that, it lowers our break-even price 71 cents. So the other discussion that I think is interesting to have is, look, we have these affirmed 36 strike puts. If these are zeroed out and it gets back to 36, we're going to make 76K, I wish, $7,600 this week. And we'll be down 15K, not the worst thing in the world. And then we could just go from there. But this break-even price and watching it go down, 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 right? We started with the 52.23 break-even price. We're down to 46.4. Roadblocks we're not going to talk too much about, but again, we started with 66 down to 56.04. But the idea, we keep a little bit of upside, and how am I calculating this break-even price? Because that is a good question that we have gotten a few times. And the answer is I'm calculating the break-even price just as if I were assigned on the 36 strike puts, right? Because if we were assigned on the 36 strike puts, we'd have 1,500 shares, and we would have a 23K loss. So maybe the better way to look at this is we have a 23,310 loss as of right now. If we were assigned on these 36 strike puts, and we divided this by 1,500, basically how much per share would we need to make back to get this 23K loss? And the answer is 1,554 per share. So if you add that difference of what we need to the current share price of 30.86, that is how we come up with our 46.4 break-even price, right? We're just going to treat this as if it were assigned stock, and we're going to monitor our break-even price this way, because it's tough, looking at this number sometimes, and I'm not going to ignore that fact. There's, a lot of emotions that get tied up in trading, and, you are not going to be happy looking at this in your account. But where I do get at least a little bit of optimism, a little bit of silver lining in a lot of these moves that we make on a week-to-week basis, is that these numbers on our break-even price tracker keep coming down. And so long as these just keep coming down, we're eventually going to get there, right? And if we did take assignment on a firm, it'd be a large position with the basis of 46.4. But again, bigger picture, let's zoom the chart out. If we own the stock at 46.4, this is where we own it on a historical basis. Let's extend that to the left. Let's move these out of the way because, they were useless. A firm went right through it. But remove that, remove this drawing, remove this drawing. So at the end of the day, as bad as the position looks, we effectively have 1,500 shares at this red line right here. And at the end of the day, that's not the worst thing in the world. Now, it looks bad right now because we have those shares at 46.4 technically and the stock's at 30. But we've seen this thing go from 176 to 30. It could bounce back up to 50 just as quickly. So we stay patient. We keep working this break-even price down. This is how much damage we've done in just, a few weeks of manipulating some of these trades, right? There's no reason that we can't keep rolling these things for about $1 premium a week. And if we keep rolling for $1 credit a week, all of a sudden, 6 weeks from now, at the end of April, this is now at 40, which is a much more digestible, more manageable break-even price. And again, that's just April. You extrapolate that action out over the course of 2022, where we have, maybe how many months do we have left, or weeks rather, maybe 40 weeks left in 2022. If you get even just 50 cents of credit a week per week through the end of 2022, your break-even price is going to be 26, and you would be making money despite this enormous slide. and not every single week is going to be red. I know a lot of weeks have been red, and they could definitely start to seem that way. However, we just have to be patient, and I am looking so forward to the day later this year where all of these tabs that we've talked about on Sunday nights, going from Affirm to Roblox to Fubo to DraftKings to Palantir, the day that we could look back and say, you know what, we have finally broken even. So that was where a lot of the red came from, DraftKings and Affirm. Outside of that, right, this is a pretty sizable loss, like 15K right here. We still made some decent money outside of those, right? And, the intention is that we get back even on Affirm and Roblox and, DraftKings, so we're not too worried about what happens there. But we're also very optimistic about what we've done on a week-to-week with some of these quote-unquote new trades. And as I kind of teased a little bit earlier, a lot of these new trades, ever since the end of January, due to the volatility in the market, there have been a lot of really, really good opportunities for us out there. And since then, with the exception of this SPX credit spread, which is not really, fully HT wheel, but if you add all of these up, we see, come back. We see 38 different trades right here. 2 of them are losers. One was a credit spread, and one is open door, which is still in progress and can easily be profitable by the end of next week. So that's you're basically looking at 36 or 37 of 38 possible trades that are winners on a week-to-week basis that are new. So if you're new to following us and you're looking to start building out your portfolio, jumping in on some of what we're doing with these on a week-to-week basis is definitely the way to start, right? And some of these did start that way, and they got to where they got because the stock performed poorly. But there's a lot of good opportunity, and this is just kind of part of what happens when you have to play defense. But again, we play defense because we're confident in the strategy. We've seen what it does long term, and we are confident enough to keep sticking with it. And we know that one day, someday down the road, I don't know when the day will be, but I'm confident that we will extend our lead against the S&P 500, and we'll be looking back at some of these trades with lessons learned, and hopefully we could laugh at it one day. But in order to be able to laugh at it, we just need to not get margin called, stay patient on a week-to-week basis, but we will definitely get there. So again, a lot of these trades that we added, the new ones, the week-to-week stuff, we've got roughly $1,500 of profit right there. Bed Bath & Beyond was a great one to talk about because that's our IV reversion strategy. What is IV reversion? IV reversion is when you see big spikes in implied volatility like this right here, right? You see this huge spike in Bed Bath & Beyond price. And I could zoom in a little bit to maybe the 20-day to illustrate this a little better. But this is a really great example of what we like to look for, right? So at the end of the day, Friday, March 4th, so not last Friday, but the Friday before that, it was trading at 16.12 when it closed. Over the weekend, there was news that Ryan Cohen, the guy who's been associated with GameStop, I want to say, former Chewy guy, but there was news that I think he had taken a large stake or at least had some sort of involvement in Bed Bath & Beyond, so it spiked way, way, way up. And we saw pre-market that Bed Bath & Beyond was up over 100% at one point. And what does that do for us, right? We don't want to just buy Bed Bath & Beyond at 30 because, it's probably inevitably going to come down, and that's what we expect to happen. But the great part about this is what you see down here with this blue line. And this line right here plots implied volatility. And when implied volatility, or I guess, to precede that, when the stock jumps like this, implied volatility is going to skyrocket, right? It went from about 1.2 to roughly 2, and that is a huge jump, right? Implied volatility almost doubled just from this big jump in the stock price. And what that allows us to do is implied volatility is one of the biggest drivers of option premium. So what that allows us to do is sell really far out of the money puts for a decent amount of premium, right? And if we start to remove some of these drawings, I can kind of illustrate where we were actually able to slide in with the position. Let's delete that, delete that, delete that. Okay, now it is cleaned up a little bit. So how do we view an implied volatility reversion trade, right? So it started about 16.5 and spiked up to 35. So Monday morning, we know that this is going to be an opportunity. We see that the stock has run up a ton. There's conceivably good news because there's a positive, management figure getting involved. But where do we target a position? And the answer is we try to get premium right around where it was trading before. So in this case, it'd be 16 to 17, just this little range it was trading in the preceding week. And you might say, HT, this thing's trading at 32 when the market opens. You think you're going to be able to get premium like 50% out of the money? And the answer, due to this spike in implied volatility, is yes. And if you look at the position we opened a decently sized position because we're so confident in this setup. We were able to sell 17 strike puts for 41 cents. And we know from an ROR perspective, that's an ROR of over 2%. And 17 minus 0.41 is 16.59. Our break-even price on this trade was 16.59, close enough right there. And if we extend that to the left, boom, that's right around where it was trading the week before. So this is why we love these trades, because the IV spikes up, and as the name suggests, the IV reversion trade, it reverts back down towards the mean. And as it reverts back down towards the mean, the great part is that as implied volatility constricts and comes back down to earth, so does the option premium. And even though we entered this position with Bed Bath & Beyond, I think either low 30s or high 20s, and it dropped all the way back down below 20 at one point, we really were never in too much danger with these 17 strike puts. And within 2 days, we were able to close these out for 9 cents of premium, meaning a $640 profit in just over a day. And on a position that really was never in too much danger, right? This red line is really not too close to where the stock was ever trading. Now, it was a little scary when it dipped below 20 on Monday, but even when it dipped below 20, you have that little bit of assurance that, it might just return right back to where it was before. And, the greater thesis with this type of trade, especially when you have a big move that's spurred by positive news, is that, okay, Bed Bath & Beyond was trading at 16 last Friday. They had good news. So conceivably, a stock that trades at 16 and has good news should be worth more than 16. So we're happy to potentially take assignment at this level if it does come to it. And again, IV does have this little bit of reversion action, but it's still a little bit elevated over what it typically is. So if we did have to take assignment, there's still ample premium for the coming week on Bed Bath & Beyond. Now, I don't know if I really want to still get into this at like a 16 strike, because now that it's down at 20, your cushion between 20 and 16 is a lot smaller than your cushion between, 30 and 17 when we entered into it. So, these are opportunities that really come and go pretty quickly, which is why we have our Discord server that has a bot that alerts them. And we're putting in some really good work on a lot of these alert bots. And I think over the next couple of weeks, we should have a decent few alert bots built out for you guys to be able to use and get alerts from. So I'm definitely looking forward to that. But again, this is probably the most time sensitive of the trades that we enter into, which is why we have a bot that alerts us. And again, we have a bot that alerts us because, a lot of these things are kind of like layups, right? This was a really, really easy $640. If you go to our performance on the year, IV reversion right here on RSX, that was $90. CTIC is at 180 right there. BBBY went really well for $640. Another IV reversion for $100. IV reversion for $95. But again, you've got over $1,000 of IV reversion profit, just in the past month, and that's just from situations like this that were alerted by the bot in our Discord. So again, little plug for HT Premium if you guys aren't already signed up. The value of some of the data that's being provided, I think, definitely covers the $25 a month. Especially Bed Bath & Beyond, if you were in with us on that one this week, that pays for 3 years of HT Premium. So that's as much as the self-promo as we'll get into. But again, tough week for us. Tough week. We've had tougher weeks. We've had better weeks, but it is what it is. This is where we're at. Now, how are we going to start getting it back, right? We've seen that there's been a lot of great opportunity on a week-to-week basis. We have this really high success rate on new trades that we're entering into. So that begs the question, what new trades are we entering into? We take a look at what we have for the upcoming week. And again, the way that we like to evaluate our profitability for the upcoming week or our positions is what would things look like if the market just stayed flat. And that might be a pretty big ask with how volatile things have been, but we want to remember that the market is just as likely to go up as it is to go down. And even though it really, really seems like it can only go down lately, and I don't want that to make you, completely ignore your downside potential on a trade, this is just the best way to evaluate it, because, a firm could go back to 36 and Roblox could go to 44, and all of a sudden we have a week where we've made $17,000. Is that going to happen? I don't think so. But again, for how steeply, use an adverb to modify the verb steep there. Yeah, for how steeply things have gone down, if we have a good week in the market and things turn around, a firm reclaims 36, Roblox reclaims 34, not Uh-oh, it's 313, not 36. Jules, what am I looking? Oh, great point, Jules. See, I can always count on my editor-in-chief to keep me honest here. I got to update that. So, but again, yeah, I mean, the idea, if we really want to be super, super optimistic looking at it, if it affirm reclaims 36, which remember looking at that affirm chart, that's, come back. There we go. 36 is not an unrealistic price for a firm to get back up to. If we look at Roblox and it gets back up to 44, not an unrealistic price for Roblox to rebound to. But again, if both of those things happen for the coming week, all of a sudden we've made $17,000 just off of those two names. And if we look at our year-to-date summary, this would probably be a very good time to link it up. So come on. There we go. This is going to equal this down here. This is going to be dragged down right here. These are going to be dragged down, as are these. Okay. I think I did that right. And that should extend all this. This is an example. There you go. So if just those two things happen between Affirm and Roblox, we're taking back $17,000 in profit. And again, these aren't like, we're not looking for Roblox and Affirm to double in a week. We're not buying calls or going crazy or anything like that. We're just looking for them to come back up to where they were trading last week. It's, a lot of these things are not that big of an ask in the scheme of things. I think we set very realistic targets, very realistic goals. And if just that happens, all of a sudden we're crushing the market so far in March. I mean, not so far, right? We're underperforming because of what happened last week. But if that does happen, we're crushing it in March. We already outperformed in February. January is one of those things where it sucked. We know what mistakes we made, and we're not going to try to compound those mistakes. So we hit the reset button on a few positions. But again, those are just two positions that could turn really well for us. If DraftKings goes back up to 18, which is another area where it was trading last week, all of a sudden that's $20,000 for us in just 1 week. So again, we want to be, patient. We want to keep rolling to realistic strikes, right? We try to keep that Affirm at a 50 strike put for as long as possible. But, at the end of the day, with how much it had come down, we just had to come down on the strike and accept that this is going to be a long-term trade as far as getting back and breaking even on it. But, all this is just to say we lost $8,000 last week. We lost 14 the week before it. Those were two very tough weeks in the market, right? The market dropped 1.27 and 2.66%, and it looks even worse for our portfolio as these things just pretty much dove straight down. But again, good weeks from a couple of names, and we are right back in the game. If you go to performance since inception, we'd be crushing it. We'd be right back up around here. So, it's only a matter of time till some of these things start going our way, and it might be a month, 2 months, even 3 months before some of these things turn around. But when they do start to turn around, these are the types of returns that we can potentially expect to see on a week-to-week basis. So let me go back here and put these numbers back in to kind of zero us out. So that was the super optimistic look at it, right? So let's look at what would happen if the market just didn't move, right? We know Palantir would expire worthless at 11.5. Affirm at 36. Where's Affirm trading right now? Ooh, whoops. I think I already had. Let's put some formulas in here, right? So we know that this would be, max of 36. Let me think. Yeah, 36 minus the Affirm stock price, which we have pulled over here, handy dandy. And 0 to get us what those are going to be worth. So these would be worth 514 if they didn't move. And similar equation for Roblox, max 44 minus the current price of Roblox, which is pulled in over here, and 0. So now these kind of update automatically, and these are going to be the prices reflected as of Friday afternoon when there's no extrinsic value. So they're trading for a little bit more right now, but for purposes of at least attempting to automate the spreadsheet a little bit and have some of these prices update on their own, this is the way to do it with this formula right here. It's easy enough for the shares because we could just pull the share price in, but this is what we got to do for the others. DraftKings, if we are able to sell 30 or 40 cents of premium, that's going to be like, if we sell 40 cents of premium on something, that's another $800 that we're getting. Fubo, the 6.5 and the 7 strike strangle that we entered into, similarly for Open Door, those are going to pull some profit. So if nothing moves for the upcoming week, we will have made $3,810, which is a 2.39% return. So that's, really not bad at all. And in the month of March overall, that would get us back down to a 5K loss. It looks manageable, right? It's not going to get everything back all overnight, but this is a decent cushion to begin the week with. And, save our bad luck last week, if we get a little bit of a rebound in some of these areas, like we talked about, this is just base level profit. If we get that big Affirm and Roblox bounce, all of a sudden, we're absolutely cruising. We're right back in the game against the S&P 500, and it's just, we're halfway through March. We have all these months to go. So that is what we're optimistic about. That is why we are still sticking with this. And again, if you don't like Affirm or Roblox and you have a decent loss on these trades, there is absolutely no reason to continue to play a trade that, you're not 100% confident in. There are so many different stocks. There's so many different options out there. Unless you are in love with the trade, I really don't think there's a need for you to remain in a trade. And I think, one of our members, Electro, who is on the stream with us tonight, had a position in JD where he sold an earnings put. It went poorly just because there were a lot of, risks outside of earnings with the regulatory nature of a lot of the Chinese stocks. They got hit pretty hard last week. But he found himself in a position where he said, hey, I've got a decent loss on this. Do I keep playing it or do I get rid of the position? And it's one of those things where, obviously we are always happy to help people, but typically once you kind of learn the strategies in the process, you're able to get to the answer yourself. And it really comes down to, do I think my money could be better spent elsewhere? And I think the conclusion he came to was that he's been doing really, really well with earnings trades that he has, also been sharing in our Discord server for those of you who want to join. But, he would prefer that his money be allocated to those because those had been performing well for him. So even though he had a decent loss on JD, he locked the loss in, whatever. He thought my money will be better spent in different positions. And that is a very intelligent decision to make. Because a lot of these things, if you don't really like the stock, you could be chasing them to the bottom. We are in progress with, a few of these things, right? With Palantir at 1139. But again, I just keep referencing back to the old break-even price tracker. And, last Friday we got it down to 1728. This next Friday we'll be able to get this down below 17, presumably. And that's just with 3 months of work. So we have 3 months where we've knocked about, $7 off the break-even price. And if you extrapolate that out, by the end of the year, we'll have a zero basis. Is that going to be how this works out? Probably not. But, provided we play some of these things long enough, we should be able to get back in the game on a lot of these names. And a lot of these growth stocks are so beat up. So when money starts coming back into the market, they're going to be one of the first targets for money to start flowing back into. But that's what we've got for the upcoming week. One of these things where, first question is, what are we looking at for the upcoming week? These tickers that we have, we still think have ample opportunity from a premium perspective. So if you are not in Affirm or Roblox, you could look at Roblox, for example. Actually, let's go look at Affirm. And you could say, okay, look, maybe we go up a couple weeks out and say, I could get an absurd amount. Actually, this is crazy amount of premium here, right? You could get 2.37% on Affirm 22.5 strike puts, which are $8 out of the money. That is an insane distance out of the money. And again, we like to target just 1% a week. Getting 2% for 2 weeks at a 22.5 strike is insane. And you might say, that's a little bit scary. Why is there so much put premium? And the answer is just because volatility on this thing is so high. So if you scroll out to the 1 year, right, volatility is almost at an all-time high on Affirm. And what do we know about implied volatility? When it comes up this high, eventually it comes back down. You'll see a spike back in 2021. It's coming up, falling back down. It's coming up, it comes back down and got a little bit more elevated thanks to this big red candle last week that we were not big fans of. But, that's just part of the game. But again, the implied volatility here, the IV rank is 80, the IV percentile is 94, meaning 94% of days were below this current implied volatility over the last year. So those are the kind of hints that tell you, okay, the iron is kind of hot. Like now is the time to strike from an option selling perspective on a stock like this. So this would be a very good option. And to kind of get back to the point that I was trying to make here earlier before I started rambling about the implied volatility is you might say, HT, this is a little bit scary. Why is there so much premium on the 22.5 strike puts? Why is there 50 cents of premium on these? Does that mean the market thinks a firm is going to go down this far? And the answer is, sometimes that is the case. And if there's one-sided option premium where only the puts have premium like this, it might be a good idea to head for the hills. That's kind of scary. But the other side of it is, look, if you look at the call side, where can you get 50 cents of premium? You could get 50 cents of premium, $10 out of the money this way. There's still this amount of premium at 40 strike options, which means that the market thinks it's equally likely that a firm could rebound back up to 40 in the next 2 weeks. But that's the idea, right? And as we roll these 36 puts on a week-to-week basis, the credit that we can expect to get is actually equivalent to the call premium right here. So long as this implied volatility stays elevated, this is why I'm confident that we're going to be able to keep whittling away our break-even price on a firm on a week-to-week basis with these 36 strike puts. And you might say, what do you mean? What do you mean that the amount that we're going to be able to drop it by is equivalent to the call premium? And the answer is because the amount we're dropping it by is the credit that we're rolling it for. And the credit that we're rolling it for on a week-to-week basis is the extrinsic value. So let's bring in the extrinsic value right here, and you'll see for the 36 strike puts, the extrinsic value is about $1.01. And if you look over here, that's, roughly about what that call premium is. And the call premium is actually a little bit higher, which indicates there's a little bit of a skew on the call side, meaning that the market thinks it's more likely a firm goes up than goes down. So that is what we're looking at right there. But again, all these names we have on here, still great premium opportunities. If the premium on a firm dropped off a cliff tomorrow, that's one where I'd consider either one, taking shares and just waiting it out, or two, just moving to something else where there's a little bit more of an opportunity to collect premium. Because while we are down a decent bit on the year, and that's something we definitely think is important to recognize, we're down 40K, let's take a look at what we can potentially expect to make if we get back to a flat or at least slightly green market. So here's our year-to-date summary from 2021, where we made $94,000, right? And it wasn't a straight line up for the market, right? We had some down weeks, some flat periods, but even with that, right, we have a neutral to bullish strategy. The only thing that gets tough for us is when the market is just relentlessly dropping as it has for the past 3 months. But again, 94K of profit was made last year with a starting balance of 86K. We're at about 135 right now, so there's no reason. I mean, we could look at what we made from June onwards last year, and that amount is 48K. So even with that amount over just a 6-month period, we have enough to get us back to break even. So I'm not letting the big numbers scare me at all. Like, it sucks to have a big number here. Do not get me wrong, but let's look back at what we did in 2020. Let's look back at what we did in 2021 and understand that it's part of the process, part of this bigger trend. And then if we just keep up what we had going right here, and again, we didn't make this money because of the market, ripping up last year. We make this same amount of money even if the market is flat. And again, a lot of these rebounds were just off somewhat flat markets, because as we look at recaps, let's look how the S&P 500 is done on a week-to-week basis, right? A little bit red, even just a hint of green in the market, right? A plus 0.81% week, we made $18,000. But again, big red week before that where market was down 1.4, down 1.8, but again, up 1.5, we made 14K that week. Like, we had a very successful week. 0.91, we were a little bit green, but again, big red week when there was a huge red week in the market. But the amount of red weeks in the market have far outweighed the little, tiny bits of green that we've seen on a week-to-week basis. But what we know and what we're confident in is, as we've talked about a little bit, the way that we have our positions set up for the upcoming week, is that when there is that little bit of green, when we do get that little bit of rebound, we are going to see the effects of it, right? And if we recoup 18K this week, all of a sudden we're looking at a 23K loss on the year. We could look back to 2021, last 3 months of the year, there's 18K, or maybe last 4 months. There you go. That makes that up right there. You pick a random 4-month period right there. Okay, that's 37K. Pick the first 3 months of 2021. That's 22K. Money comes, money goes. It's tough to look at the numbers sometimes, but we just have to trust the process, know that our break-even prices are always getting lower, and that I'm going to sound like a broken record saying that until we break even on a lot of these positions. But again, we are well positioned to potentially do so. So for the upcoming week, one thing that I really want to talk about is stock picking, right? And that's something I teased a little bit at the top of the stream. And I think this is something that would be interesting to make a video on because it's another good piece of info for those of you who like to use the scanners, like to introduce a little bit, more of a maybe scientific or mathematical approach to what we're doing. And a lot of the issue that we'll run into is, one, we're using a little bit of leverage, but two, we run into the issue where a lot of these stocks that we're holding, right? The market was down. Let's see what SPY was down. SPY was down 1.27% on Friday. Let's look at the stocks we held. Roblox was down 5.3, Affirm 15.5, DraftKings 8.3. So there's a little bit of an issue, obviously, when the market is down 1.27% and our stocks are down an average of like 7 or 8%. That is tough to combat, right? Because as we know from the way that our positions are set up, if our positions only dropped 1 or 2% in a week, we're probably going to make money that week. The amount of premium we're collecting right now is just that high thanks to the volatility in the market. Excuse me. But, we can use this to our advantage. And from a stock picking perspective, we might say, okay, how can we avoid picking stocks where, look, when the market is red, we can handle a little bit of red, but we want to avoid a lot of red. So is there some sort of a metric to help scan for that? And the answer is beta. So let's clear this out. Here we go. We are in the scan, the stock hacker, pick a stock scan and select beta. What is beta? Beta is the measure of a stock's correlation to the overall market. So if a stock has a beta of 1, it means it is pretty directly correlated to the overall market. So if the market goes down 1%, you could relatively expect the stock to go down 1%. If the market is up 1%, likewise, you could expect it to go up 1%. And this could potentially help you find stocks that are a little less volatile. And if we intersect, a beta scan with an ROR put scan, we might be able to find some candidates that are relatively correlated to the overall market that'll save us from some of these larger swings while still offering us a decent amount of premium on a week-to-week basis. So that's what I'm excited about. And we're kind of going to do this live, but we're unfortunately not going to be able to get to the final product live because for whatever reason, when I have 2 screens going at once, as I do right now, Thinkorswim does not let me save scans. So I will talk about the theory of all this. We'll set it all up, and then I'll post the results in the Discord server to see what we can see. But from a very high level, let's talk about the inputs right here on the beta scan. So for example, if we wanted something, let's say we're worried about the market running all over the place, and we wanted something that's not correlated with the overall market. And that's kind of the idea with the IV reversion trades, right? We have a really high win rate on those, and it's because they're not correlated with the overall market. And, that can be a good thing sometimes when the overall market is not doing well. It's a great way to kind of have almost a safe harbor to be playing a little bit of a different game than everyone else is playing out there. And I think it's a great way to introduce some diversity into your portfolio. But let's say you wanted to target stocks in particular, which didn't necessarily have any correlation to the overall market. So a beta of 0 means that there is no correlation. And what does it mean when you go onto either side of 0? As we mentioned earlier, if you go positive, there's a positive direct correlation, meaning 1. And once you get to 1, that is the most direct correlation, meaning that if you have a beta of 1 and the market goes up 1%, you could expect your stock to go up 1%. And everything past that is kind of a multiple of correlation, right? So if the market goes up 1% and the beta of a stock is 2%, the beta of a stock is 2, you could expect that stock to go up 2%. And when you go negative, that suggests an inverse correlation with the overall market, whereas if the market went up 1% and your stock has a beta of -1, you can expect your stock to go down 1%. So that is a high level of how beta works as far as, using it to evaluate stocks and how they behave in relation to the overall market. But let's take that information, apply it, and take it a step further to help us try to isolate some stocks right here. So we're going to clear this, and we're going to look for beta -0.2, max 0.2, meaning that these are relatively uncorrelated, just to get an idea of what comes in right here. And we have 215 different stocks. Let's customize this to actually bring in beta so we can see the actual measure of beta. So if we bring in beta and we see a lot of these are, hanging right around zero-ish. If we take a look at the closest to zero, it's going to be TFLO. And to show you an example of what this looks like, and I didn't do this before, so I could just be entirely wrong looking at this, but in theory, this is how it should work. And we look at SPY, the overall market, over a similar 1-year time frame. There you go. I mean, there's pretty much zero correlation, and I have no idea what this thing is and why it's been trading at basically 50.32. Maybe we could find a different stock on here that's a better example of this, of having no correlation. Maybe NVT with a beta of 0.01. Let's look at NVT. So there you go. I mean, not terribly correlated, right? Because you see a little bit of a drop when the overall market dropped. But again, it has been relatively flat over the last 3 months, where the market has not been relatively flat over the last 3 months. That is what a beta of 0 looks like. Now let's scan for something. Let's say, I want a little less risk. And talking about degrees of correlation with the overall market, when we mentioned that a beta of 2 means that if the market's up 1%, your stock is up 2%. Maybe you want a little less risk in the sense that if the market is down 2%, your stock is only down 1%. That would be a beta of 0.5. So if we wanted to look between 0.4 and 0.6 for moves that are a little bit more muted, 0.6, and scan for those, we're going to get 317. And let's do this by volume here so we can see what's going on. Snapchat surprisingly has a beta of 5, which is very interesting to see. But there you go. I mean, in a sense, since the big drop off from earnings, right? Maybe a little bit more muted in terms of how the stock has moved in relation to the overall market. But if we want something that is just directly correlated, we could maybe look at the 0.9 to 1.1 range. And there we go. We've got YUMC, which has a beta of 1, which is interesting because it was down 15.5% on Friday. And this is one of those Chinese stocks that got hit pretty hard. But before that, I think one interesting thing that I admittedly am not aware of with beta as of right now is what time frame it measures this over. Because I think just looking at these two charts, they're not as correlated as you would expect theoretically from something with the beta of 1. Maybe let's try XLK. There you go. This looks a lot more similar to what you would expect with the beta of 1. So potentially for YUMC, that big drop made it, swing back into a range that was perceived as, correlated. But, one of those things where the scanner is useful to give us just a huge chunk of information. Before entering into a trade, obviously you would throw the charts on here. You'd make sure that beta, is not some sort of false result. But again, XLK, this is a much better example of what a 1 beta would look like. You could look at UMC. Is that what that was that I saw right there? UMC. Yeah, there you go. I mean, a little bit more correlated in the sense that, over the past few months or so, we see a lot of similar action right there. But again, we don't have to go through every single one of these to show what beta looks like. But the idea is that, let's potentially try to target some stocks that aren't as crazy from a beta perspective. And if we go to Market Watch over here, let's go and just put default watch list and bring beta in. Let's take a look at the beta of some of the stocks that we've been playing. Beta right here, just out of curiosity. And again, I didn't do this before. I have no idea how this is going to turn out. So there you go. SPY, great example, has a beta of 1. It is, directly correlated. DraftKings has a beta of 1.5, so it typically outpaces the move from the overall market. And, the more that you sort these things, you have some of the usual suspects up at the top here, right? You have a firm which has been making some insane moves, has a beta of 2.7. Open Door, some of these other trades that we've seen over the past few months, a lot of these have high betas because their moves have been outpacing the overall market. But there you go. You have the S&P 500, which is basically 1. Rocket NIO is a surprising one, but again, one of those Chinese stocks where there may be some, some strange action with that beta reading right there. But down below the line here might be where we take our watch list. And again, we did this by going to the Market Watch tab and just going to default to bring in our default watch list. Sorting by beta is a really good way to potentially look at your watch list and get an idea of, okay, how big of a swing can I expect on a given week? Surprising to me that Roblox has a beta of 1, and that may have to do with the shorter trading history right there. But things like UWMC, lower beta, lower moves during the week. BRPM, absolutely a very low beta because that thing has been stuck at about 990 for the last couple months. But again, if you have a watch list and you want things that are a little bit more correlated, you could potentially go right around this one range and pick out some of these. Fubo 1.3, that's a little bit elevated, but Netflix, Google, unsurprisingly Amazon, some of these larger things that make up the overall market are closer to 1. But potentially, let's see what happens. I don't know if it doesn't work this way, but what we would do, hypothetically, and what we're going to do after this is, we have Stock Hacker, we have a beta scan. We could potentially consider, between 0.9 and 1.1 to be correlated to the overall market. So what we would do is we would go here, we'd save that scan query, save it as, just beta. And then you would go to the option hacker. You'd bring in your high ROR puts without earnings, and you would intersect it with the beta. So you would know that of all of the puts that it gives you, right? Because, clear that. Because we know that when we scan for high ROR puts in the coming week, we normally get like 1,000 plus results. And that's a lot of information, right? We've got 1,500 to scan through. For the upcoming week. So that's a lot of information to potentially, cut into and process. So with that in mind, how do we cut into that? So intersecting, as we talked about last week, is a really, really great feature to do that with. And if you intersect that with the beta scan, you'll get stocks that have high premiums for the upcoming week and are correlated a little bit more closely to the overall market as opposed to something like in a firm where there's been some huge moves that have been really tough to handle at some points. But again, one of the best things that I like for this is intersecting it with stocks that are oversold. So I intersect this with HT oversold stocks, which is just a very basic oversold RSI scanner. And you'll go from 1526 down to 28 different stocks. And what you'll get from here is some very, very high ROR on a lot of these, right? And a lot of these fall into that, China stock basket. So some of those I would stay away from. However, there's some interesting options in here, right? You'll see that VIPS shows up on there. Let's look at VIPS to see what that looks like. Follow through with the process of, what fully using these scanners and investigating looks like. So there you have it. I mean, some pretty big red candles. It looks like back on, what date's this? February 22nd right there is trading at 10, and it's starting to fall off the face of the earth. I think if I back this out, it would look like a SPAC. Maybe not. Maybe this was not a SPAC. Interesting. Don't really know exactly what this is. What do we do when we don't know what it is? We go to analyze. We go to fundamentals. We type in VIPS. And we'll see discount retailer for brands in China. There you go. That tells me everything I need to know about VIPS and why I really don't want to touch it. But, back to the larger point, why is this a very, very useful feature, the intersect feature? And the answer is because we have all these stocks with a bunch of ROR, and that pretty much cuts the implied volatility scan part out of it, because we know that when a stock has high premium, it probably consequently has high implied volatility as well. So we could really cut into this by saying, okay, what stocks that have high IV are potentially oversold to the point where they're about to rebound? And if you look at that VIPS chart, irrespective of the fact that it's not a great option because it's a Chinese-based stock, look at that 1 year RSI. It's back down to 29, back in the blue. What happens when RSI gets in the blue? Short-term rebounds. RSI gets in the blue, short-term rebounds. Blue, rebound. You get the point. I'm not going to keep repeating it, but you get it, right? So everything on this list conceivably is a stock that is, one, has a really decent amount of premium because implied volatility is elevated, and two, is primed for a rebound due to that RSI reading. So two technical factors really working for you. And, we're not going to do this, but you would go through the process, you get your ROR in here. Let's see, return on risk. And you could say, okay, all the way down at 6, I can get a 1.69% ROR We really like that. The MMM's 0.27, meaning that the perceived possible downside for the coming week is 625. 6 falls below that, and voila, you have a trade. But we don't like the stock. So we could go a little bit further down and maybe look at something like TBLA, which I fear may be really similar. So let me look it up here first before we give you bad info. Israel-based software company. Interesting. Let's take a look at what TBLA looks like. So there you go. Over the past year, it was hanging out around 10, potentially because it was a SPAC. I'm not really sure about this one. I don't really know anything about it. If we go back a little further, I don't know if I see anything about acquisition company in here. Looks like it was started with the $14 price target, and it's now down at 5. Whoops. Let's see. Yeah, not really seeing anything that would suggest that this was a former SPAC. I think they've just a company that looks like it's been caught up in the recent performance of the market. But again, what do we have? We have elevated implied volatility as compared to where it normally is. We have RSI down in the blue, meaning that it is primed for a bounce on a 1-year basis, let alone on a 180-day basis, right? So we take a look at the options, and we look at the 1-year chart. 5 is the all-time low, so it's probably tough to find any perceived level of support below that. But unfortunately for this one, they only have options at the 5 strike. Now, if you're able to get like a 25 or 30 cent fill on this, it's kind of an interesting value proposition because you'd have a break even of 470. But again, there's really not a lot of volume here. This is one I would probably stay away from, not knowing anything about it. But to avoid running into dead ends continually, because this happens sometimes when you look into these things, Snow is a really good example of a company that, exists, is a little bit more reputable of a company, has fallen onto hard times after reporting poor earnings. And there you go, a huge gap down from, 260, now down to 180. So what happened with this one, and we had actually played it right off of this for a little bit of IV type reversion off this enormous drop, right? So it opened, I think, this day at about 215. We were able to sell like 205 strike puts and make a little bit of money on that, but worked out really well. However, another really big outflow of cash on Friday from 202 down to 180 has this thing looking maybe potentially attractive for an entry. So back to that 1-year chart again. This comes up on here because implied volatility is elevated. We know RSI is below 30. That potentially implies a good entry point. This is the 1-year chart. It looks like the low right around here was 184. It broke below that, which is a little bit scary because, when is it going to stop? 3-year chart, really nothing below that. It is at an all-time low from when it IPO'd back in September of 2020. This thing had been all the way up at 429 at one point. We looked at the live news. I think one really good way to potentially ascertain what a good value on this stock is, especially after earnings, is seeing where analyst targets fall. So let's see what's going on right here. Snowflake stock falls. Let's see. There should be lowered to 240. 313, 230, 344, 270, 359, 415. All of these decidedly above 180. And again, I like to lean on a lot of these analyst targets because, there's only so much technical work we could do as far as evaluating a stock is concerned. I mean, these are the people at these banks whose, livelihood is a little bit more or less affected by the price targets they put out. So they have decent research, decent ideas behind these price targets. So I tend to trust them. Not so much to say, oh, it's going to come back up to 230 or it's going to go to 359, but more so just to say, it probably isn't the worst thing in the world to own this thing under 180. So again, we like 2 technical factors. We go to the 1-year chart. We see that the RSI is below 30. We knew RSI was going to be below 30 because it showed up on this scan where we intersected higher ROR puts with oversold stocks. We knew that going into it. So the other thing we like is high implied volatility, suggesting that at one point when this thing levels out, it's going to fall back down as it typically does, right? This big drop right here back in April and May of 2021 was accompanied by a big run-up in implied volatility. When it rebounded, what happened to IV? It went from 0.75 back down to 0.5. It fell off the face of the earth. Mahir, what's going on? Welcome to the stream. Thanks for checking in. But this is potentially a good option based off RSI and implied volatility. So let's look and see where we could potentially get that 1% ROR for the coming week. And what is insane, and this is great to see because this gets at the big reason why I love this scan that we have thrown together, intersecting high ROR puts with the oversold scanner, is look where you can get 1% with decent volume. You could get 1% at a 155 strike on Snowflake. A 155 strike on Snowflake, if we look at this on a 20-day basis, or maybe just look at it post, earnings collapse. 155 is all the way down here. And what does the MMM tell us up here? It tells us that there is a plus minus 1091 move on the stock. I mean, even the regular expected move is 17, which would put the low end of the range at 163. And again, you would get it at 155. And again, if you wanted to sell one of these, I imagine there's some decent margin privilege that comes along with it, right? Normally it would take $15,000 of collateral, only takes $1,500, meaning whatever return you get, you multiply by 10 if you are using margin to calculate your ROC, return on capital employed. So 155 looks very, very nice. If you wanted to ride the lightning and, follow the MMM to the letter and go 170, decent, but for the trade-off between strike at 170 and 155, that's pretty significant to only get 2.72 compared to 1%. So I really like that. And another thing above all else that I think this scan is really, really good for is the long-term cash secured put trade. And we did it with the firm. We did it with Roblox. It did not work great because of our position sizing off the bat, because we incorporated earnings, and really didn't use this type of a scan to identify it. But at the end of the day, when I really sit down and think about it, and the more and more options I evaluate off of what this scan gives to us, I think this is kind of the quintessential long-term cash secured put trade. And what I mean by long-term is in that 60 to 70 day window when the theta decay curve is a little bit different, because when you sell something super far out of the money, theta decay actually ramps up around that 45 to 60 day window. So if you sell something 60 days out that's decently far out of the money, you are going to be the benefactor of that increased rate of decay. So instead of just looking at a weekly basis, and again, there is still a lot of great opportunity on a weekly basis on this one, let's go 68 days out of the money to this May expiry. And all of a sudden, we'll see that we could get 2% ROR down at 100. And you might say, why would I want to get 2% ROR, for a 68-day trade? That is, what's that? That's like 10 weeks. That's 0.25% ROR per week. And the answer lies in the margin, right? If we wanted to sell 10 of these, one, that would be $98,000 fully cash secured. So I'm not going to sell 10 of these. But the idea, you could maybe roll this down to 5 to make this more digestible for the sake of the example. It would take $5,000 of buying power, and you'd be pulling $950. If we pull up our handy dandy system calculator here, you will see that $950 of profit divided by the $5,000 of buying power it would take, 5,002 to be specific, is an 18.9% return over roughly a 2-month period. How many 2-month periods are there in the year? There are 6 of those. So, I mean, if you really extrapolated this thing and, raised it to the 6th power, 1.18, 2, 3, 4, 5, 6, all of a sudden you have a 172% annualized trade if you did this 6 times throughout the year. So is extrapolating that a little bit extreme? Yes, because one, you wouldn't want your entire account leveraged into this. That's not good. But if you have, 10 to 15% of your account leveraged into this, or maybe 5 to 10, if there's, such an extreme leverage amount, generating, what could potentially be what I perceive to be a high-ish percentage annualized return of about 200 on just 10% of your account, is still a really, really good option, because that results in a 20% overall return on the year just from these. And again, that's a 100 strike on Snowflake that we're looking at right here. And why is there so much premium on a 100 strike? The answer is because of these situations and these technical indicators that we've looked at right here, with implied volatility being the main offender, right? And 100 strike is all the way down here. Can it get down there? Potentially. Don't get me wrong. That can happen, which is why we don't want to sell 10 of these off the bat. We want to sell maybe 2 or 3 off the bat. And even if we sell 2 of these off the bat, that's $380 that we'll get in a couple months. Is that a ton of money? Not a ton by itself, but if you find one example of a trade like snow, and then you start pulling different ones from this list, and all of a sudden you have 5 or 6 of these or 7 or 8 of these going at one time, and you have 8 trades that pull you $300 or $400, all of a sudden that turns into $3,200 over the course of 2 months. So diversity between a lot of these long-term CSP type trades I think is very, very important. And striking when the proverbial iron is hot is also very important, because when this thing rebounds and implied volatility gets sucked out, these are the ones that get hit the hardest, right? You might not even have to wait until May. You could be in a position where if Snowflake rebounds a little bit next week and implied volatility drops, this could potentially go all the way down to like $1, and you could get half of your return in 1 week. That is the great part of these. It's nice to have a little bit of peace of mind knowing that this stock could drop $80 more over the next 2 months and you'll still make money. But beyond that, the fact that even since these positions are bullish to neutral, if you do get that bullish move and Snowflake does rebound, what was initially a 2-month trade can become 50% of max profit in just a week. So I really, really like the idea behind these. And while Affirm and Roblox didn't work because 1, we introduced earnings risk, and 2, we sized in way, way, way too big, I'm not going to let that discourage me from taking a smarter approach to this style of trade. And I think this is that quote unquote smarter type approach. And the great part about this is, right, in the next 60 days, we know that they presented earnings beginning of March. Next 60 days, there are no earnings for Snowflake. So there is, relatively zero binary event risk, and all of this premium you're seeing right here is just pure implied volatility, and will be at the mercy of the increased theta decay curve due to how far out of the money it is, sitting in that 45 to 60 day till expiry bucket, right? And we could potentially look a little shorter term at 110 for 155, but I think the May for 2 is a really, really good deal. And honestly, I really like the idea of adding a couple of those tomorrow morning when the market opens, potentially targeting a $2 credit. Because, it's not a home run. One example is the Facebook trade that we're holding, where after they presented earnings and gapped down off the face of the earth, when it was at 240, we said, Facebook, if you look at the earnings, right, Facebook is not just Facebook.com. They own like WeChat or WhatsApp, one of those two. They own Instagram, Oculus. They have all these different lines of business. They have a ton of cash, and they're generating a ton of cash, positive earnings. So we said, let's sell a 200 strike put. And we were able to sell that for $4 a premium expiring in April. And again, Facebook has continued the skid. However, we only sold one of them. If we took that same approach that we did with the Affirm and Roblox and loaded up with 15 off the bat, it would have been potentially catastrophic. But, learning from our mistakes is very important. There is going to be one day down the road where our account hits a new all-time high. We're going to have all these lessons learned. We're going to have these new strategies and systems built out where we are going to hit that all-time high in our account before the end of the year, and we are going to take that opportunity and be ready to seize it. So again, we sold the 200 strike put, and you could see the little sad little flag here at 200 strike, where it's trading at 17-ish right now. But again, we sold it for 4 strike, and if we want to roll it out another month to like May or something like that, we can do that for what would presumably be about a $10 credit, which would get our break-even price from 196 down to 186. And that's fantastic because that's right around where Facebook trades. And the idea is, and this is really the idea with pretty much all of our positions, between IV reversion, general position management, whether we're entering into a coverage strangle or not. If we could lower our break-even price to get around where the stock is trading on a trade where something's moved against us without increasing our position, we do it. And if I have to roll one Facebook contract from April out to May just in the pursuit of a $400 profit, I'm going to do it, because that is the, easiest way to just low stress, have that thing working in the background. And 2, I'm not going to spend more money if I don't need to, because if Facebook drops to 150 and something catastrophic happens, that is when I add that further position to then aggressively start chopping that break-even price further and further down. So that's the idea right there. But again, big takeaways from the stream tonight are, one, the lesson we talked about with beta and stock picking and how you could use the scanner on Thinkorswim, or whatever web-based scanner you may be using is definitely going to have beta as a scannable feature, but how to use that in order to help improve our stock picking so that we're able to find things that, behave a little bit more in line with the market, especially if we want to measure our performance against the stock market. Having that tool of beta in our back pocket to be able to analyze and identify positions that correlate more or less with the overall market should be very helpful from a stock picking perspective. Two, I love this scan right here, and I love the idea of having this be the genesis for our future long-term cash secured put trades. Snow is a great one, the way that this sets up with that 100 strike put for, what was it, May that we were going to sell that for? Whatever it was, 70-ish days away. It is almost comical to me that you have this much premium on this, and I think we're going to sell 2 of these Monday morning, targeting a $2 credit, which is $400. And you might say $400 in 2 months, that's not a ton. But again, the idea is you keep an eye on this scanner every week, every day. More and more of these are going to come across, and we will build up more and more of these, have a more diverse portfolio of long-term cash secured puts. So instead of having, something like Roblox and a firm where we have 2 positions that hold 30 contracts, we'll maybe have 30 positions that hold 2 contracts. So we're much better protected and have much better, odds of potentially bringing home profit and being able to, to profit. So with that, we have, we are at an hour and a half on the stream. We are rolling, but I think we had some really good stuff to talk about. And these discussions that we're having here with the scanners, I think are going to be very, very important, especially as we build out that automation feature in our Discord server, so you guys can help, not only just getting the data, because it's one thing to have the data, obviously the important thing is knowing how to take that data and make reasonable and profitable conclusions from it. And this is all what these discussions revolve around. So again, for those of you who have tuned in, we did not quite hit the 30 viewers, so we cannot do a giveaway, but we are definitely going to put a more concerted effort into, growing the Discord server over the next few months, advertising the streams a little bit better. So hopefully we will have a HT giveaway sometime soon. But again, for those of you who have tuned in, thank you for watching. This has been Hourglass Trader, where as time passes, we make money. And hopefully next week, we will be talking to you after we finally get the turnaround that we have so desperately been waiting for. If we don't, that's okay, but sure would be a lot nicer if we did. Thank you guys, and we will talk again next week.